Welcome back to another YouTube video. Disclaimer, I did not take any trades today. Today was FOMC day. We don't take no trades when there's FOMC. Even if it's at 2 fucking p.m., we don't do none. The price action usually is very shitty. Usually it's all consolidation before the big move. And as you can see, yes, I'm on the 5-minute, but it was a big ass move and lots of people got taken out and I just did not want to be part of this. So I will show you two demo trades. One demo trade that I took, and one demo trade that is just literally demo. I went to back test, and that's actually what we're going to be talking about. Now, I don't want to. I know I do this in a lot of my videos. I get sidetracked by talking about one thing that happened and one of my mistakes, and I don't actually talk about the wins and what I should have looked for. If you guys know anything about my current analysis, what I like to do is go on the daily for the S&P 500 and let's just hide this for a second. Go on the daily and I just like to look at the daily candles, right, where they're heading. As you know, the S&P 500 was super close to hitting that -4 standard deviation, which is right here. NQ, I'm pretty sure also almost hit it. So we had a lot of confluence up there. Now, the daily, I'm looking for daily imbalances. That's what I'm really looking for. So what does that mean? I'm looking for order blocks to be created. I'm looking for fair value gaps to be imbalanced and to be rebalanced. And I'm looking for liquidity to be formed. As you can see here, the only imbalance that we properly got out of this whole entire daily was there was two. There was this little tiny gap, or three. Tiny gap, fair value gap here, and then order block, right? Now, the problem is these imbalances are all down here. They're all in this yellow box. This whole yellow box has a bunch of imbalances in it. So until price comes down into this area, there's really nothing up here on the daily that I'm really looking for, right? Now, if you notice, price actually today came down and hit the top of the fair value gap. And we'll talk about that in a second. Let me do this, right? But on the daily, as you can see, this was FOMC. This was Tuesday. And after the daily, we have literally no confluence. There's a lot of liquidity, as you can see on these lows, but really that doesn't, sure it's important, but it's not, they're not imbalances. So I don't target those points. On the 1 hour, you can see that SPX has been extremely bullish, some equal lows down here. Lots of manipulation. There's a lot of manipulation. Then we saw accumulation and then more manipulation. And then we had distribution, right? So almost like a quarterly theory from Friday, or was it Thursday? Maybe Thursday to Monday to Wednesday. So yeah, lots of manipulation and then lots of distribution. Some main things to look out for. Now on the 1 hour, this is what I noticed. This wasn't the highest high. The highest high was here. But I took this high here due to it being in was a New York session on Tuesday, created the New York high, if you will. And I took this and there was a 1 hour market structure shift, if you will. It was probably more accurate here. But this was the swing low that it made. And that's what I took it from. As you can see, the standard deviation is what I drew out. Now, why this is important is because the standard deviation usually tells us where some levels of price will be reacting off of. And I love standard deviation because sometimes, and I mean, I like the word sometimes because sometimes it works so well if you know how to use it right. If, for example, I deleted the standard deviation and I took a price point from this high to this low, and I draw the standard deviation, it's not going to line up with anything. You know why? Because I'm not doing it right. Now, the standard deviation can be used in different ways. The only way I've personally been taught, so I know there's other people that teach how to use it in other ways, but the only way I've been taught how to do it is to spot a potential market structure shift. So let's say this is going to be bearish because of that swing low. You go from the low and you look for a high to be created. Now, this high, right, it has to be the highest high in the session. It can't be like a high like this. It can't be under this high. It has to be the highest high. So it breaks all these highs. It has to sweep some kind of liquidity, which was up here. So these equal highs. has to be the swing high of the session. And from this swing high, it needs to create a market structure shift from this low down here, which you can see here. So that's valid. So to me, this little range, I'll mark in yellow, this little range is where that standard deviation is going to come from, right? So we go from the high that it got created to the low that it broke. You can see the standard deviation lines up. Now, in terms of targets and price targets, when you're in a trade, usually you would target, in my strategy, and what I like to target is from the -2 to -2.5, depending on the liquidity, PD arrays, anything like that, or imbalances that are around that level. And if there's something more confluence before or after, then that's what I would target. Now, if I'm trying to figure out where price is going and what it will react off of, this would not be target wise, right? We'd look at where's the -4, right? Where's the last leg? And you can even go into a bigger one and look at where's the -5, where's the -4, where's the -5.3, stuff like that. You can really go down and look at those kind of levels. As you can see, that level did not quite match up. We almost got to the -5, but not quite. I just like this one because it's a little bit cleaner. As you can see, what I did with these gray boxes, you might be thinking, why are there gray boxes here? What is this? Now, this is due to the ranges that I have. So from the -1 to the -1.5 and from the -2 to -2.5. Now, these areas are usually the areas of either reversal or the areas of confluence. Now, what I like to think of it is if you look at the -1 to -1.5, I already knew that this was not going to hold up very much due to two things. The first thing is that price, when it came down at 5 a.m. on Wednesday, created almost equal lows, almost the consequent encroachment, almost to the 1.25. What does this mean? This means that it did not trade all the way down, and it's looking to go lower because we're bearish off this high. We've obviously broke structure, and it's looking bearish. Obviously, in this confluence, in this range confluence, we have nothing. There's no what's called there's one order block here that's right under it, but it didn't reach for it, which means that price could easily do what it's about to do, is come up and then absolutely pierce through that order block, which is exactly what we did. But anything can happen. These wicks also show there's less support. Yes, there's volume, but there's less support in this area. And there's just no imbalances. There's nothing to fill. There's nothing at all here in here. But when you get down to the lower ranges where it's more in discount, you'll realize that the -2 to -2.5 line up with almost this low, which is right under. This imbalance of this 1 hour fair value gap, which could be something you're looking at. The consequent encroachment also lines up with an order block. So there's a lot of stuff here. And if you haven't noticed, there's also a balanced price range, which is sitting right here. Okay, this bullish fair value gap, bearish fair value gap, and then another bullish fair value gap. So this is like almost a, what's called a, I forgot the name of it. A reaper. It's a reaper. That's what it is. Reaper. A reaper fair value gap. And so you can see the standard deviation does give us those pretty nice levels. Now, I did make a crucial mistake that ended up causing these losses. I didn't really trade, so there was no loss. But what I had planned, or what I had thought, was this high that created this market structure shift. And this is where you want to pay attention. What do? We say, okay, well, if this is a sell model, obviously because it's a bearish market structure shift and also broke this swing low, so it's a really valid market structure shift. We're looking for what? Obviously, we're bearish, but we're going to be looking for bullish order flow to come back into some kind of PD array here to then go short again. Now, unfortunately, as you saw, because we had FOMC and because we had news yesterday, price didn't do exactly what we hoped for. Now, today, what I thought was going to happen and what I hoped for was for price to hit, the PD array here and then to trade up in here and then to come down. That's what I thought it wanted to do. And so what I did in Discord is I called out at, when was this? 9:35, and we'll talk about this. I said, possible buy model might be hard to enter after 10 known, right? So I saw this buy model here, and I'll talk about this right now. We'll go straight to the 5 minute, and we'll look at this buy model that almost gets created. So what I had was, here you'll see this wick was the 830, and it creates buy side liquidity. We come down 835, and we trade inside this what? This is the standard deviation. Also confluence. This is what I like to see. 9, we sweep that consequent encroachment. We trade above 905. Boom, boom, boom. Where's the 930 open? 930 open is in this candle. Now, when I saw this, when was this? This is probably right. I'm trying to find this high here. Okay, so this was the 930 open. As you can see, what I had was this. I thought that this would break and do a market structure shift, and we get a buy model to the upside. As you can see, what didn't happen? We didn't get a buy model at all. There was no buy model, and it swept. The mistake was, well, there was no buy model. That was it. That was my mistake. And I should have not targeted these imbalances here. Although it was smart to target this, I think that we were already so deep into discount that it was not smart to target anything in premium already. And I think with news and this 830 and everything, there's so many imbalances. Everything, as you can see, sometimes this is manipulation. It spikes up to grab liquidity, or spikes up to take out all those traders that are swing trading, and then it comes back down. And you'll see this in FOMC too. It spikes up to really go down. This happens all the time. But what really happened, and what I noticed, I'm pretty sure this was a 15 minute. No, this was a 1 minute. Where was this? Yeah, it was definitely like a 5 minute or 10 minute. Where was it? Dun, dun. Okay. On the 5 minute, there was another sell model that happened. So, you had to switch your buys, but this is what you could have caught. There was another sell model that happened. Basically, no, this was definitely on the 1 minute, because this is not lining up with the 5 minute. If you're trading on the 1 minute, oh yeah, it was here. Come here. There we go. If you're trading on the 1 minute, you'll see that 830 opens, right? I don't really love to do these kind of setups in pre-market, but if it works, it works. And this is just one that I wasn't paying attention to, but you can see it worked pretty well. Again, just disclaimer, if you're watching this, I did not take this trade. This is just a demo trade to show you that the strat works, and that if you're paying attention to the right order flow, you'll catch the right trades, right? That was another video I made. So what actually happened? Create buy side. We trade down, manipulate down, or distribute down, my bad. And this is just accumulation for the 930. And as you can see, we have a swing high, but that swing high comes from what? A swing low, or you can even say there was, what's called equal lows down here, right? Or you could actually even say that this, oh my bad, this was the swing low down here, right? So swing low down here, which created that 1 minute market structure shift, which to some people, this might not be enough confluence, at least take this trade. For me, it was, so I took it. Or I didn't take it, but I would have taken it. Market structure shift, right? You can see if this doesn't work, it doesn't work. Let's check it out. 830 comes down. Okay, now what you're looking for is for it to create a range. So what we're going to do is we're going to draw our OTE. We're just going to drag it down. Let me just click this OTE. We're going to create a range. Now, we can't trade, so we're going to hope that price trades down, which it does, and it trades even more down, which is fine. 903 down here, so we can't trade quite yet. Comes up, I'm a little scared. Okay, blah, 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 comes back down. But here, you wouldn't mark this low. You'd mark the range that it just created is low. So whatever that range low is here, whatever that range high is there, right? The mother high, the mother low. From this swing low, you can notice that price does start to come up, and then 930 comes up. And I want you to notice something. There's something very interesting. This 930 wasn't very aggressive. You might notice that there's some other openings that are extremely aggressive and way more aggressive than this one. But what actually happened on this one was that we didn't need the OTE, because what happened in this whole gap down, there was only one imbalance that was first created that not only looked good, right? The eye was good, but that got respected, which could be an entry. And so right off the bat, if you've even been trading for ICT for over a year, you would notice this 1 minute fair value gap. Now, trust me, there's another one right here. Yes. But this one is created, but it gets invalidated like 5 minutes after. The only one that doesn't get invalidated is this one down here. It also gets respected with these two candles in that wick. All the bodies close under this fair value gap. All of them. What do we do at 9:30? We trade into it. You enter off consequent encroachment because of a sell model. You put your stop. Now, yes, you could put your stop here. You know why I didn't do that and why you wouldn't do that? First of all, this isn't the OTE. So the fair value gap is a little smaller, and fair value gaps can range from here to this. So putting your stop at the top of the fair value gap is not a smart idea. What I had in plan was, okay, what's a protected high that would not be broken if price really wanted to go up to this liquidity point? It would be this high. So notice how it's not this buy side, because if we really wanted to go up, we would just break through this fair value gap. So this is now my protected high, and it's also lined up with equal highs, so that was fine. Okay, now the target. When we drew that standard deviation, right, you can forget about this, and the bigger standard deviation. This is our trade standard deviation, so it might look a little messy, my bad. Now we have two areas. We have this first area right here, and we'll mark that in like blue. And we have this second area, which is our profit area. So I'm going to mark that in like green. Okay. Now this first area is looking for, this is usually where I look for like reversals, or like if the trend isn't going, or maybe usually the price, when it comes down first, right? As you can see here, the standard deviation has already hit, or this price has already hit the -1. So I know damn well that when I enter this position, my first take profit, my first target would be to break this low, because it's already gone down to that standard deviation level. So that means it can only go further. It's already pierced through it. It's not like it's discovering that price action here. So that first price movement I'm looking for is below this low. And as you can see, we get that clean structure right down to this low, break of the inner liquidity, and we go right down to this low, which is fine. But this is also where I'm looking for a possible reversal, maybe another buy model, who knows, right? What I want to see is a nice break through this range. That means that we can either inverse this range, as you can see. Let's go ahead and draw the consequent encroachment. You can see that we inverse price. You could even enter off of, for just a tiny small trade, you can even enter off of this inverse. It's not a fair value gap, but standard deviation, trust me, works like a beast when you know how to use it. So that was our first thing. Now the profit, you can see that targeting -2.5 isn't actually that crazy, because if price really wanted to come down, right, if we go even to the 15-minute, we look at this trade, and if it started selling off from this point here, if it wanted to sell off, what's the area to target for the 1 hour, for example? Because this is the 1 hour standard deviation, right? It would be the -2.5 or even the -4. Now, -4, you're not really interested until you see that. Also, there's FOMC, so you don't want to really see a bigger move. Now, this usually is also a place of reversal, so you don't want to, it's also a place where both of these are places of reversal, so you just want to see price action. So what I personally would do if I was in this trade is I would obviously take profits here, whatever, maybe down here. I would take partials. I would like at least have 1 or 2 partials already taken. So if price does reverse in this area and you tag this area, it's done for. Okay. Now look what's cool. Let's say you said, okay, well, a price is going to reverse the moment it taps the standard deviation or the -2, then you could target the -2. Guess where that lines up though? That the target is already below your -2.25. Isn't that crazy? That means that where you're targeting with the standard deviation here is literally not even half a tick, maybe 3 ticks away. Yeah, like, okay, 10 ticks away. From the actual 1 hour standard deviation. So if you said, okay, if price needs to come down to this level, this gray box, to reverse, then that's what we can target. So if you target just even the top, that's still a good trade. That's still fine. You can see it hits perfectly. Now, does it reverse? This is where you look at price. So you're out of the trade. You're out of this -4. Now, yes, we do hit -4, but that's with FOMC, so I'm not worried about that. I don't want to pay attention to that. Do we reverse? Well, this is what you look for. And this is actually what, I didn't call it out, but this was during math class. I remember this exactly. I'm pretty sure, yeah, 1050, yeah. I was watching this. Wait, was it during math class? I can't remember. Anyways, this is my thought process. Okay, well, if it reverses in this 1 hour reversal thing, I want to see a buy model get created. And guess what happened? 1 minute buy model gets created. But something is wrong. We'll look through it. Ready? Low gets created. High gets created. Okay. Now we have our internal, this is what I like to call the internal range for the buy model. Usually when we create this is a pretty good sign that we want to reverse, because after a big move like this, it starts what? It starts accumulating. And then what ultimately happens is the buy model goes through. Now, what was really the selling point for me was this wick. As you can see, this wick completely swept the -2.5. So I thought at that moment, okay, yep, buy model's inactive. We're good. From this low, what's the mother high that traded into a fair value gap? So it's the intermediate term high. It would be that little high right here. Now, yes, if you did your analysis right, you would say this is the high. But guess what? It's the same fucking market structure shift. You're still bullish, right? The only thing that's changing is what? The standard deviation. So if you took this high to this high and you draw your standard deviation here, your now standard deviation is here. Notice the problem? You don't get your entry and profit target has already hit. That's bad. So that's not good. Hence why I went higher. But I should have known. I should have known that this was a mistake too. This high is also an intermediate term high. It's also the more aggressive, I guess, the more aggressive high that you would target for a buy model. It also lines up with equal highs, and then it also gets broken on the first candle. That first candle here creates that first fair value gap that we're looking to target here. Just put this in yellow again. Okay, that's what I'm looking for. But like a dumbass, I had my standard deviation up here. So I was like, oh, yes. Oh, yeah, look. Price hit the -1.5. Almost the -1.25. So I was like, oh, yeah. When it comes down, it's going to hit all the way up here. It's going to be great. What did I forget? I forget that FOMC happens in what? Literally 3 hours? Still, 3 hours? That's a while. You know, price actually starts accumulating like 3 days before FOMC actually happens. So 3 hours and 3 days is a big difference. So 3 hours accumulation is definitely a thing. And you can see this is exactly what happened. We come up, obviously we come down. I'm over here getting fucking hyped. We're about to get our entry, consequent encroachment of this fair value gap. Oh my God. Remember, even if we draw, what the fuck just happened? What just happened? Okay. If we draw our OT from down here to that high, my bad for this. You can see where's the entry. The entry would have been down here, but I targeted the fair value gap because it was more accurate. You can see that if we got our long here and put our stop below this low and not above here, we would have got stopped out. It's not exactly what I love to see, unfortunately. And when this happened, I was like, what the hell? Because I was trying to trade this live, like with real money, but last second I was like, hey dude, FOMC is in a few hours. Don't trade live money. You're gonna lose. It's not a really good setup because this really isn't like an imbalance. It's just something out of the blue, like a prediction. So yes, there's a buy model, but it's not super high probability. And usually the more aggressive one already showed you that the move already happened. It showed you that the more aggressive one, which is the high, the move already happened. The target already happened. So this would have just been like this. This is what should have happened. Whoop. We don't even look at it. It's over. It's done with. What we do look at is what happens after. So what happens? Still, price comes down and it sweeps this 1 hour standard deviation imbalance again. What does it take out? Southside liquidity. That gets created right here. Oh, perfect. What do we look for again? I look for another fucking buy model. This one, in this case, is a little cleaner. And you'll, wait, why is this here? Oh, wait, yeah, this one here. This one's a little cleaner, as you'll notice. Two things. First thing, it's less accumulate. Well, it's still accumulating, but there's less accumulation. Price makes a very nice, takes out the sell stops. And this is where you're like, okay, well, it comes up. And you're like, okay, this might be the high, the internal high, but no. Because that low isn't the lowest low. So you take this low. It's also equal lows. Perfect. From this low, where's the high? Or where's the, like the swing high? The more aggressive one is this one. The more less aggressive would be that one because it's also trading in a fair value gap. Notice the problem? Yeah, profit targets are up here. There's FOMC in like not even an hour. So let's not do that. So I was looking for the smallest one to target, and that would be that one. Okay? What happens next? Swing low to swing high of that range, draw the OTE. Now, if you didn't have the OTE and you didn't want to use OTE, let's do a little lesson that I've learned. From this initial range, this swing low to that swing high, there's no imbalance that gets created here. So to me, from this swing low to this and that, whatever lines up with this is part of the move. So whatever imbalance gets created from this swing low to that point here is considered an imbalance. Okay? What do I look for? I look for fair value gaps. I look for order blocks. I look for anything that matches price. There are two things that catch my eyes. Two things. The first thing is this 1 minute order block, this body here. Okay, so you can see positive order block. The reason for that is because it came down and then had a propulsion up, and this is what created that OT high. Okay, that was the first thing. The second thing was this 1 minute fair value gap, which was technically the first fair value gap that we created in this whole entire range. Okay. Now, you might notice that these, especially this fair value gap, is a little small to enter. Okay. And you might notice, oh yeah, he's entering out here. Why? I'll show you. When we do the OTE, which is this high, that's where I entered. We had confluence down here. So the psychology, and I don't know if you can really tell, but the OTE line is here. The psychology and the mental issues would be, oh God, price is trading under the OTE. My stop loss is just getting hit. But if you notice this, you would say there's an order block. There's also a fair value gap. What's most likely to happen with this fair value gap? It's going to get traded into. There's orders there, but it can go lower. Why? Because there's an order block. High probability order block right there. Where will it not come down to if we want to see price go up that low? Why did not? Oh, but French, why did you not target this low? Because mentally, I know that if price comes down to this low, which just created that huge propulsion up, I'm already out of the trade because I know it's going to take out that low. So why not get out earlier? Now, the last resistance stop would be like this order block. I don't have anything else. Like the very last stop would be the last order block. Like if it breaks, if it even pierces through this, I'm out of the trade mentally, right? If price pierces through that. As you can see, we got lucky, or not, my bad. We didn't get lucky. This was our strategy. You can see price respected the order block and respected the fair value gap. I'm more likely to look at this order block because it's cleaner. Respects to the OT. Now, it doesn't close above the OT, but it does close that last line of defense on the OT, which is fine. I'll take that any day. Now, I did say in the Discord, I did call this out in the Discord, and let me find it real quick without leaking anything. Here. I said, currently in a demo trade because of news at 2 and did not want to trade with a price action with real money. Fine. 104. This was the current trade. Now, notice how high the take profit is. It's so high because I had it up here. I had it at the negative 2.5. And the problem with that is, oh my God. The problem with that is that the FOMC happened or was happening in, when was this, 105? Like literally 30 minutes, 25 minutes, maybe. Yeah, not even 15 minutes. So I was like, you know what? Fuck that. We're not going to target those highs because that's not going to get hit. What I'm going to do is I'm going to target the first range, right? This first range, as we talked about on standard deviation, this first range, that's what I'm going to target. That's what it probably wants, okay? So my take profit is here. Obviously, if you had partials on this little trade, perfect, right? But look what happens. Just look what happens. And this might not look good to a new trader because of this candle, but look what happens. We hit this order block. We trade. Almost there. Notice where we are though. Oh, wait a minute. We're right above the 1.25. So at this moment, I knew that if it came down, it would go back up to negative 1.5. So my take profit here would be validated. What happens though? We come up. Uh-oh. We're inching towards 2. Uh-oh. FOMC's coming. Uh-oh. And boom. Traders here will think that I got stopped out. Oh yeah? Shall we go to the 5 seconds? Shall we? Let's go back to that trade real quick. Wait, where'd it go? Wait. Where the fuck's the trade? Oh, there it is. I will show you this body. Tell me if I got stopped out. Yeah. Yeah, you're seeing that right. A bullish candle came, took profit, and then dumped. Yeah. Yeah. So that candle took her profits, and there was no stop loss. We're out of the trade. There it is. Thank you. Bye. Goodbye. No. What happens next? FOMC happens, right? Good displacement. I guess this was all right. This was most definitely not the best thing you wanted to expect or to see, you know, during a position. But that's what happened, right? That's just what happens, unfortunately. You can see that -4 on that 1 minute sell model. -4 does come in clutch all the way down here. Boom, boom. Back to the 1 minute. You can see FOMC does react off of this. Listen, no trader should be trying to like predict prices with FOMC. You let it play out, and if there's a setup that happens after FOMC, go for it. But at 2, there's FOMC statements and everything gets released. And then at 2:30 is when Jerome Powell speaks. So you have a literal 30-minute window to take your trade. And that is probably the riskiest window you could ever hope for. What happens though? 1 minute. We reach this this level here, -4. You can see we come down even more, or we consolidate, we come down even more. We have these lows down here. Act as super strong sell side liquidity. What happens? Oh no. Is that a buy model? Is that an ICT 2022 buy model that gets created? Wait. That cannot be right. Hold on. This low creates an intermediate term high, which is in this fair value gap, which is marked as a market structure shift when this candle breaks above and closes above. Then what happens? We get the initial move, which at first, you notice there's no imbalance. What if we take our fair value gap, our trusty fair value gap, and we put it right here? Boop. This little tiny range, creates an OTE where you could enter, obviously target the lows because this is a very risky one, and never go into drawdown. You'd be in drawdown for like half a second. Would anyone take this trade? I doubt it. This is incredibly risky with real money, so I didn't take this trade. What you could have done though, if you missed this entry, like I'm probably sure everyone did, because this happens very fast, right? This is 1, 2, 3, literally like in 4 minutes, it's over, done. You missed the entry, you're fucked. If you're paying attention, you would not be fucked. But there's also a second entry that happens because it's called it's called a institutional order flow entry drill. It's a little harder to understand, but it's basically a fair value gap that gets created and traded right through. And then there's buyers or sellers that come right back into it to buy everything back. Now, this wasn't a institutional order flow entry drill, but it was kind of like that. Now, what happens? This internal range creates an outer range, and as you can see, this is 235. So when does Powell start speaking? Right around here, right when you would enter. You can see we get initial pump here, and this is our second range. Now, what this creates is a second OTE, and you can notice on the, what's called the standard deviation here, you can see that this price action has already reached into our initial range of reversal. Whoops, not too big of a deal. Initial range of reversal when it breaks this, comes up. You probably enter down here, comes up, comes up, comes up, comes up. Reversal area doesn't quite trade to the negative 1.5 or negative 1.25. Comes down and then trades all the way up, breaks through all this, almost in -2. All right, so that's good confluence to trade all the way up to this range. So now if you're going to take a second trade, you would target this higher imbalance or higher range. Okay, take a look at this. OT gets hit here. We have a 1 minute order block again that gets created right here. As you can see, price absolutely disrespects that order block, but it does. It closes right above that. It closes above this 1 minute OT like completely. So if your entry was something like this off the consequent encroachment or off the OT itself, because that orange, you can see that orange line, it's very faint, but it's there. Plus the order block, your stop loss would be these protected lows, and your take profit would be what? -2.5, -2.5, right? During FOMC, a ICT 2022 buy model, back to back. During FOMC, I'm telling you, this shit works when you use it right. When you have the right order flow and you know what's going on, you have the right levels, this shit works. Let's also just do another one right here, just to show this shit works at 1.5. Okay. I'm telling you, this shit works. 3 trades you could have taken today. Now, obviously, you wouldn't have taken today. You wouldn't have taken anything because remember, FOMC, so no big confluence, literally nothing. Saw some setups, but everything is consolidating for FOMC. Okay? One mistake that I did was, again, getting the order flow wrong in the beginning session, not paying attention to the 9:30 opening price and just the first like 1 hour of price action after 9:30. Again, having like an external bias before the market even opens is sometimes it can be deadly or sometimes it can be really good. In most cases for me, I don't know what I'm doing, but I'm getting the wrong bias like almost every day. And I've had people, oh, the bias is bullshit because if you know what you're doing, then it's good. But here's where bias comes in clutch. Bias. Now, there's a difference between personal bias and market bias, right? If you have a market bias, that means that you know where you don't know. You have an idea of where the market might be going. You have a bias towards that direction. If you have a personal bias saying, oh, this market's going up because of this and because of this and because of that, and I personally believe that that's not how you should do it. Because if you personally do it, then where's the analysis? I want to have an analysis bias. I want to have a bias that is stood upon by my analysis, either the day of or the day later, right? I want to have a analysis bias or a bias based on analysis, right? That's the right bias to have. Now, you want to have a bias on the weekly, monthly, daily, 1 hour, 5 minutes, whatever. It doesn't matter. Have a bias somewhere. Obviously, if your bias is bullish and you're looking for a buy model to be selling later in the day, that's also fine. But the daily bias changes every day. The monthly bias doesn't change every month, or it changes every month, yes, but it doesn't change every single day, right? Your monthly bias should be it's bearish. But guess what? You might be looking for bullish prices in a bearish month. All right, my throat hurts. I'm gonna go take a break. I'll see y'all tomorrow. I hope this video helped. Peace.